These are buckets someone else already prepared for you.
This is the, I would say, black belt of investing.
There's this mantra they're saying that in the stock market that if one person wins, the other person loses, and that's not true.
The social media team of Trade Republic invited me to give today my hot takes on the different asset classes on which you can and maybe should invest.
Hey YouTube.
I'm Dilara and I work in the social media team of Trade Republic.
I'm Matthias Bacchino. I'm the markets lead at Trade Republic.
I'm Julian. I'm the general manager for our international markets.
So let's start with the first one. I have this beautiful envelope.
You might recognize the logos of companies, and companies, when you want to invest in them, are called stocks.
You're like a shareholder. You own a little piece of that company. And eventually a stock gives you three things with that. The first thing is you participate in the value creation of that company. So if the company becomes worth more, your stock becomes worth more. And if the company is worth less, also your stock is lower in value. The second thing is a stock gives you the rights to participate in dividend payments. So if a company makes profits, they can decide to pay out those profits to their shareholders. That's what a lot of companies do. And that's very important because if you're a stockholder, you have rights to get those dividends. And it's especially important because a lot of people sometimes when they think about capital markets, they think that if one party wins, the other party loses, but they often forget about the dividend payment. So without you selling or buying a stock, you can still participate in the economic value that a company is creating. And then there's a third thing, and that is that you have voting rights. You can participate in the General Assembly.
I'm an Apple investor, so I come after Tim Cook. No, like jokes aside.
Since 150 years, it is very clearly the best performing asset class. Make a difference between stocks as a whole and one stock, because one company can always go down.
They require a lot of research, I would say, and a lot of patience.
For me, it's clearly a 10, but one stock is a 7 because it might be difficult, especially for beginners, to select the right one. I'm pretty sure Julian and Dilara will score them lower because they love another asset class, I'm pretty sure. Let's see.
I would think I would give it a 7. With a stock, you put all your eggs in one basket. You basically say, I put the value that I get into one company only. And that has a certain risk.
Long story short, only, in my opinion, invest into stocks where you did proper research, where you see long-term value, and leave your money locked. Leave it with the company. I would say for me, it's a proper 7 out of 10.
Another one. Ooh, that's actually one of the greatest inventions of the history of mankind.
So these are ETFs.
FTSE, MSCI, and the world, so I assume it's the MSCI World logo here.
Exchange traded funds. When I started at Trade Republic 4 years ago, this was the first thing I've learned. I don't want to do my research. I don't want to buy Apple and then Tesla and then, I don't know, buy Novo Nordisk and make my own bucket. These are buckets someone else already prepared for you.
ETFs are basically the easiest and cheapest way to invest in many stocks in one go.
Why are ETFs so amazing and why do people love them? Well, because an ETF, it spreads the risk by investing in many things at the same time. It also reduces the upside potential to a certain degree because you don't have that one outlier that you put all your money in. You also have some stocks that maybe are not performing so well or some assets in there that are not performing so well. But in general, it spreads the risk.
Let's say Nvidia is not doing well. The quarterly results have been bad and the Nvidia stock is actually crashing. And Nvidia single stock investors will feel it. They will feel the magnitude of this crash because they're holding the stock itself. But when you're a S&P 500 investor, you might feel it a bit, or you might not feel it at all because the other stocks in this ETF are balancing it out.
My take on ETFs is that it's one of the most important things happening in Europe at the moment because it's the best way or the easiest way to get a little bit of your share of economical growth.
Yeah, so I would say as they're less risky and less volatile, I give ETFs a solid 9 out of 10. It's not a 10 out of 10 because still you have risks, right? And you also have costs, not as high as actively managed funds, but still some, which you can see in the Trade Republic app, by the way.
I would probably give it a 9 out of 10, maybe even a 10 out of 10. It comes very close to being the perfect instrument to invest, especially for newbies, because you spread all the risk and you don't really need to look after it that much. If I think about my colleagues, I know this is also being shot with Dilara and Matthias. Matthias would probably give it for sure 10 out of 10, maybe even 11 out of 10.
They are an 11 out of 10.
Yeah, this guy is in love with ETFs. Nice, so we have some countries in here and a interesting sign that must be bonds.
It's like you become a bank, so someone wants your money. It could be a government, you see Germany and France here, but it could also be a company.
Bonds are very attractive again, and I recommend you learn how to use them, because bonds have a specific characteristic which is very different from stocks and ETFs, because bonds, they are more certain. By that, I mean, you know, when you buy a bond, what is going to be your return? What you don't know, of course, if it's the state or the company where you lend money to will pay you back.
Some bonds are more risky than others. So if you give Germany money, the government of Germany, you will get an interest rate. I think it's around 2.5% right now, which is nice. But you could get a higher interest rate when you give your money to the government of Romania, because Romania is not as solid as Germany.
Why do I think that bonds are underrated? Well, first, because a lot of people have not used them really. But the second thing with a bond is that it's so predictable. With bonds, I know that if I invest it, whatever amount is for 3 years, I get 4% interest on that every year. So I know exactly what I'm getting out at the 3-year mark. I would give it a 7 out of 10 as well. They don't have the huge return potential because they're so safe and predictable, but the predictability, I think, is something that is worth a lot.
Due to its complexity and since it's still not very accessible, I would say 6 out of 10. It's accessible with Trade Republic. I think the knowledge is not there yet, the awareness.
It's probably at the moment an 8 out of 10.
Another black envelope.
This one is not for everybody. This is the, I would say, black belt of investing.
Because there's the oil can, that probably means we're talking about derivatives.
Derivative products are some financial products with so-called leverage into it.
This is something I know, so you can go long or short. When you go long, it means I believe that this company will grow in value. Like the price will move up. Going short is the opposite.
For example, if you invest into the S&P 500, they can multiply the performance of the S&P 500, but it goes both ways.
If you ask me how to use a derivative and if everyone should use it, well, I would say it's a difficult product and it's something that is quite risky because it's super volatile. So if you really want to use a derivative, make sure that you know how it works, that you understand also the details. There's different types of derivatives, knockouts, warrants, so that the factor is that you understand the different risks that they have, but also opportunities that they have.
I see people making lots of money with it because they use leverages like times 10, times 20, whatsoever. But I also see many, many people losing money on Reddit.
Don't burn yourself too fast by listening too much to your greed to get returns, because it will make you lose money and therefore you will not keep learning how to invest. When you start playing football, you don't go immediately to the World Cup against Brazil.
Due to the risks and what I've seen on Reddit so far, it's only a 3 out of 10.
I would give it a 5 out of 10. I think it's an important measurement that eventually was set up for different reasons than the stock market and is used for that now as well. But it's something where you can lose a lot of money.
I will give the medium score because derivatives are not bad or good. So I will give a 5 out of 10.
So these were my hot takes on 4 different asset types.
Let us know what is your favorite asset class for investing at the moment.
Thanks everyone for watching. Let me know what you want me and the team to rate next. We have a lot of products that we can talk about, and comment below if you agree or disagree with our ratings.